Moving on, and sometimes I like to start with kind of a big picture concept and then get into some further details. What I want to touch on this morning is the belief system, or the breakdown in the belief system. This is one of our 2Q themes, and 2Q is almost over, but that doesn't mean that the reality of the belief system breakdown isn't still real. But even going into institutional meetings, people don't quite get it, so I wanted to kind of do the 101 on what this means. For everyone. So in the first slide here, I framed it up in the form of a question. So over the longer term, the currency of a surplus country with relative deflation will do what? Because this is what a lot of these countries are fighting. Do you have any guesses on? There's basically two parts to this question. So surplus and relative deflation. So if we take it in those two parts, if you're a surplus country, so let's just to kind of do the 101, all right? Let's suppose I'm the US, I sell things in dollars. You're Japan, you sell things in yen, and I want to buy things from you. I need yen to do that. You want to buy things from me, you need dollars to do that. If you're a surplus country, that means you're selling more to me than I'm selling to you. And on net, that means I need more yen to buy that stuff from you. So the demand for yen is going up, right? Mm-hmm. If the demand for something is going up, generally the price of that thing will follow and appreciate as well. So that's the surplus side of the equation. Relative deflation, if we go to the next slide here, the second slide. So if the price of goods and services is going down, or going up less relative to what's happening in the rest of the world, then each unit of currency can buy more goods and services. So in other words, if your purchasing power is improving, and if a unit of currency can buy you more things, then its value is increasing. So the currency itself appreciates. And you can kind of flip that around and think of it the other way. So if a country has rising inflation, then it means the currency is losing purchasing power at home. And similarly, exchange rate depreciation means that, or implies that a nation's currency is losing purchasing power in international markets. So relative inflation equals depreciation of a currency. And this is what and remember, these are longer term forces that are driving things. So you have something like $4 or $5 trillion traded on FX markets daily, which is, I don't know the exact multiple, but it's something like 25 times GDP on any given day. So financial demand kind of swings things, oscillates, and drives movements in the short term, but these longer term fundamentals drive the currency movements over the longer term. And on the chart here, we're showing what's happened in Japan as a little bit of a case study here. So in the top part of the chart, the yellow line is the CPI, so inflation growth in the US. The white shaded area, blue shaded area is Japanese CPI. In the second part, the green bars show the spread between the two. So negative spread means deflation, or relative deflation in Japan relative to the US. And you can see what happens there on the bottom chart, the pink line, the currency appreciates. And if you're not used to looking at these things, you see the chart going down, it looks kind of confusing. That actually equates to an appreciation of the yen. So 106 on yen spot means that's how many yen a dollar can buy, right? So if you could buy 110, it means you could buy more yen with a dollar, meaning the yen is worth less, right? So down and to the left actually equals an appreciation in this chart. So I guess that's the broad macro lesson of the day. So I guess the point though, so for QE, for these measures, these policy initiatives that are happening in Japan or Germany or the EU or where have you, for those to have the desired effect, the market has to believe that policy can overcome these larger fundamental drivers. So in other words, they have to believe policy can drive real growth, sustainable real growth, and relative inflation. And as we've seen, the market is voting against policymakers' capacity to do that, at least so far in the second quarter.